Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, today's episode is dedicated to a question that many investors have been asking. What is the bucket strategy for retirement? And we have with us Dhirendra Kumar to discuss it in detail. Welcome, Dhirendra.
Thank you.
First up, let's kick off this conversation with a question that's on many investors' mind. They've been asking what is bucket strategy and how effective it is when planning for retirement.
The three bucket strategy is basically the immediate term money should be lying in your liquid fund or in your bank account. Medium term money should also be somewhat like that, maybe little potential optimized investment, largely conservative. Because the money that you need in 18 months time or 20 months time, you can't take any inordinate chances with that anyway. But if it is for a little negotiable goal, maybe you can look at an avenue which can give you little higher return for a little no incremental risk. Okay. And then long-term money could well be in equity, but in an allocation which is actually palatable for you. If you haven't experienced equity ever, if you can't really reconcile with 10% up and down in a month's time, then you have to really calibrate. You have to get into the market in a manner which is manageable. But it's important to be investing in equity for your long-term money.
Right. So it's all about safety, growth, and long-term planning. Yeah. Right. Now, the next question is, how should a retiree allocate funds between these three buckets, to maximize returns and minimize the risk?
That also depends on the retiree, his state. If you live with your children and your children are very well off, your situation changes. If you're a central government employee and you have entitlement to central government health scheme, then your emergency fund need actually is curtailed dramatically. So your health insurance, so the essentials, everything depends on your context. Do you have a retirement income? Will you be getting pension? Will you not be getting any pension? You need to plan for investments. Regular income from your investments is a different story. So bucket 1, bucket 2, bucket 3. Bucket 1 is emergencies, and having some money handy at all times is important, even despite having any kind of comfort. And that could be 3 months income, 2 months income, or your own situation. Your health condition will actually warrant how much emergency money you should have. Second stage is if you are going to depend on these investments for your income. I think having 18 months worth of income requirement into a debt fund, which is not very volatile, which is not very vulnerable to interest rates, a short-term debt fund, for example, is a good thing to have. Okay. Because your second bucket is your medium-term income requirement. The third is that the money that you are unlikely to need for many, many years, and you only need to derive some income from it. So maybe another 18 months of income into a hybrid fund. And the remaining money into an equity fund, and working on your asset allocation like this, drawing from the fixed income and leaving your equity to appreciate. That is the bucket 3. Okay.
And then the withdrawal rate.
Withdrawal rate you have to be extremely careful about, because withdrawal rate, many a time people think that it is my capital. 8% withdrawal rate will be comfortable for me. But in bad times, 8% can actually eat into your capital, because if the market goes down by 5%, and that is the time when you are taking out 8% from that, your capital will not remain 100%. It will come down to something like 94, 95%, because market is going down and you are withdrawing. So making sure that you have a conservative withdrawal in bad times. I would imagine that 5 to 6% withdrawal rate, half of the gains in first few years. Because if your investment is growing at 12%, you leave 6%, you take out 6%. Then next year it could be 10%, 12%, 15%, take out half, leave the half. I think, be very flexible about it. And if that is a very important dependence, then doing this kind of flexible withdrawal will make sure that, you are eliminating the possibility of, consuming your capital. Reducing your capital you potentially run the risk, more so in the initial years. Because in a couple of years, you'll be able to build the cushion. If your capital goes up by 5%, which means that the incremental capital, 6% is your withdrawal rate. So I would say that, somebody should be very careful about his withdrawal in the first few years. One should be extremely conservative in the years when the market goes down, your capital does not appreciate. Don't try to take out money in times when the capital has gone down, and in 3-4 years time you would have built a buffer. If you are able to bring your withdrawal rate to 4% of your capital, I think you will be not running the possibility of outliving your savings, because that is a big risk. If whatever amount of money you have created, if you are dependent on 8 to 9% return from that, withdrawal from that, then there is a possibility that in 5-7 years you will get an occasion when your capital will be at its lowest ebb, and that is when you will take your 8%, and that is when your capital will get depleted.
Okay. Now comes rebalancing. So it's kind of complicated, more so for a retiree to figure out how to rebalance this portfolio. Can you please explain us?
Yes, rebalancing is complicated. Rebalancing has tax incidence. The way to do rebalancing is that most investors in their retirement will be having some kind of fixed income, guaranteed fixed income, something like senior citizen savings scheme, post office MIP. Keep that fixed income aside and you are taking out consuming the income from that anyway. Second is that you will have some equity investments, and then have some proportion of aggressive hybrid fund. And on an overall basis, take a look at your asset allocation at Value Research. If it is 50-50 as a result of this, do all your rebalancing entirely through the equity fund or the aggressive hybrid fund.
Okay.
Because fixed income, you will only be taking out, only when the market goes up, that you will take out money from equity and put it in fixed income. So create a window of aggressive hybrid fund for a mix of equity and debt. On an aggregate basis, you will be able to look at how much of your money is in equity, how much of your money is in debt. If it is equally into equity and debt, and you have decided for yourself that 60% is your threshold, it goes up to 60%, you will reset it to 50-50. That is when you should actually do some iteration. Try and do as minimum, as little transaction as possible, because all the appreciation will be taxable. So don't try and do too much too often. Just move your money from equity to this aggressive hybrid, because these are the only two flexibilities you have.
Right. So what is your final takeaway for a retiree who is planning to implement this bucket strategy in their retirement?
My suggestion will be that think about it, because most retirees don't think. They go to somebody who will actually think from his point of view what is good for him. Nobody is better than yourself to think about yourself. And nobody can be bigger well-wisher of you than yourself. And nobody has awareness of your context better than you. And your experiences are one of the biggest determinant of what you can do and what you are, psychologically very comfortable with. This is a fancy word, first bucket. Emergency, make sure that you have enough emergency, whether it be in liquid fund or whether it be cash in your locker. Don't have too much cash in the locker. That itself, poses risk. Second is that, the medium term. Any medium term plan, 1 to 3 years, whatever you are likely to need, should be handy. You should not be assuming risk. Only money which you are unlikely to need for 3 years and more is something which you should be invested in equity. And even in retirement, make sure that, if you are fortunate to actually build some cushion, that you can have a conservative allocation, 50-50 equity debt, able to earn, rebalance it, nothing like it. Else, make sure that, you are following these short-term, medium-term and immediate thing. Short-term, medium-term and long-term thing earmarked, and applying some mind itself will actually solve a lot of problems, because many a times people look for a solution in somebody else, and looking for a solution in somebody else has its own problem. Somebody will have knowledge about something. I'm not saying vested interest. It is just that most people are not knowledgeable about the whole arena, the risk, the downside, what not to, and on many occasions, people are just in a hurry to give you a transaction, enable a transaction rather than worrying about and giving the right advice.
Well, hope that answers all your queries about the 3-bucket strategy. Now, moving on to the viewer's question. Vineet Shekhar has sent in this question, and he says that he has 2 ELSS funds, one which has given him 21% XIRR and another one which has given him 16.5% returns. So he's been doing this SIP in them for the last 6 years, and now he's switching to the new tax regime from the old one. So should he stop investing in these funds or continue regarding considering the high XIRR? He wants to know, as there are no tax benefits in the new regime.
He can well, discontinue if he feels so. Because tax saving fund is nothing but an equity fund, a diversified equity fund, a diversified domestic equity fund, which provides the fund manager a premise that the money coming in will not leave in 3 years' time.
Yes.
Now the flow into these ELSS, equity linked savings scheme, these funds have come down substantially ever since the creation of the new tax regime, which does not incentivize any tax saving investment.
Right.
You are at liberty to put your money wherever you want to. So you will not get a tax break on your investment. Earlier the situation was that under Section 80C, you are this much investment up to 1.5 lakh rupees will be deducted from your income. So that was a big one. But now it doesn't matter. So let your investments continue. Don't switch your investment because there is no tax benefit on your new investment. And entire new tax regime, there is no benefit. So you can choose your fund of a fund that you like and make sure that you keep investing. But don't think, this return of 21% or 16.5% both look very handsome. And it is entirely a function of when you started which one. Because if you started at a lean period, then it might look 21%. If you carry on, if it is exactly the same amount of money invested at the same point of time, then of course the other one looks much better. And it is handsomely better. 16.5% and 21% is very meaningful difference. But otherwise my guess is that it is entirely a function of this kind of difference in a good fund. Is entirely a function of when you started. In a bull market, lump sum benefits. In a market which is very volatile, SIP really helps optimize your returns. So it depends which phase of the market, what kind of market you are benefiting. So my suggestion is very simple. Don't take your money out if you need, because your appreciation will get reduced by 12.5%, which is the capital gains tax. You can avoid investing more in these funds because why lock in your money? Choose it, but make sure that you continue investing in equity and ignore the difference in XIRR even while differentiating. Look at the time period when you invested, because this kind of difference can happen in equity fund over any time period.
Well, that's all we have for you in today's episode. Keep watching the space for more information. If you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.